There are 5 types of homes you should never buy. And here's the catch. None of them look dangerous, and some of them look like a great deal on paper. And most people think the homes to avoid are the ones with the obvious stuff, like foundation cracks, or even a bad roof, or the stuff that you actually see. But that's the thing. If the homes were obvious, nobody would get stuck with a bad home. Because some of these homes, banks won't lend on, and the others just nobody wants. So when you go sell, you're just stuck dropping the price just to get out. And your realtor isn't gonna bring this up because their job is to get you into the house. And I know this because I'm a mortgage expert who's helped over 500 families, and I've bought and sold 15 plus units, and I've made some of these mistakes myself. So I'm gonna walk you through all 5, and just one of them is enough to trap you in a home that you can't sell for years. So you wanna know all 5 before you make an offer. The first type of home that I would avoid with a 10-foot pole is a non-warrantable HOA, or even worse, a defunct HOA. Now, most people have never heard that word, and that's the whole problem. Warrantable just means Fannie Mae and Freddie Mac will back a normal loan on the building, just fancy words for you can get regular types of loans for the HOA. Non-warrantable means they won't, meaning you have to get special loans, and special in mortgage lending industries is not a good thing. Special means there's not many people offering that type of loan, therefore the rates are worse. So they could be because of a few different things, right? That makes it non-warrantable. It might be too many units are owned by investors instead of people who actually live there, because guess what? Investors will foreclose before a primary owner will. That causes a lot of risk, right? And maybe one company owns a big chunk of the building, especially if there's 8 to 10 units and someone owns 4 of them, that's a big problem, right? Because if that person goes under, that's a big problem for the whole HOA. Or maybe the HOA doesn't have enough money in reserves. That's a big one. Or there's an active lawsuit against it. So here's the trap. You find the perfect unit, great building, great price, probably because guess what? It's non-warrantable. And you think you're, ready to go. And then you go get your loan and the lender after lender after lender says no because it's non-warrantable. So best case, you end up with a special portfolio loan. And remember, I said special is never a good thing in the lending industry. Higher rate, you also have to put a bigger down payment, usually minimum 20, recommended 30% down or more. Worst case, you buy all cash or you walk away, right? But here's the part that really gets people. The day you want to sell, your buyer hits the same exact wall that you also ran into. Their lender's going to say no. The next lender is also going to say no. So now your buyer pool shrinks down to just like a handful of cash buyers or people who are willing to do the portfolio special deal, and that's it. So it just sits on the market and you drop the price over and over again. Now, when you got the good deal, guess what? Someone's going to be getting the good deal on you. So I had a client fall in love with a unit right on the water in San Diego. It was around $1 million, which is, again, crazy to say, right? But for that area, call it a great deal. Gorgeous building, she loved it. As we get further along in the process, there was huge plumbing issues that spanned across all the buildings, on the water. And it was deemed non-warrantable because of the huge major repairs that needed to happen. And of course, the HOA said, yeah, it's gonna take 6 months to repair. Guess what? 2 years later, if you didn't know this, if you favorite something on Zillow and you favorite the listing, right? You get notified when it gets taken off the market, sold, etc. So it finally sold 2 years later. Guess what? At a huge discount because of this huge issue. She sent me a screenshot and she was like, thank goodness I didn't buy this. Thank you so much for talking me off the ledge and all that. She ended up buying like a single family. It was further from the water. But guess what? It saved her from a huge headache. So again, that's the trap. You can end up owning something that you can't refinance out of or you can't sell for what you paid. So real quick, every single home on this list has something underneath it. They're a nightmare to finance going in and a nightmare selling coming out. So the real question is, are you set up to land a home that actually closes and hold its value? Or are you going to fall into a trap? That's actually why I built the free homebuyer readiness quiz. It takes less than 30 seconds. There's no credit pull, and it tells you if you're ready, if there's a gap in education. I'll give you short videos to solve that exact thing so you can avoid buying the wrong type of house. It's completely free. It's my gift to you, and we're going to get you a free, bonus guide. What a great throw. Home ownership free trial guide. It'll show you how to find your comfortable payment before you fall into a trap of a house and before you buy a house. Again, check it out in the link down below. All right, let's get to number 2. All right, so this next one is sneakier because the trap isn't the home at all. It's a number and it only moves in one direction, which is up. People who see the HOA dues on the listing, they build their whole budget around this number, right? It's like, ooh, super low HOA or reasonable HOA. This fits with my budget, so we're good to go. But guess what? Stuff always gets expensive, and that HOA isn't gonna stay the same amount forever. And like I mentioned, what's even worse is the oddly low HOA due that looks good on paper, but there might be some hidden things that can cause it to double or even triple. Maybe it's a special assessment coming, maybe it's the roof needs to be replaced, maybe the plumbing has failed, like in the example I mentioned earlier, or the elevator might die, or maybe there's a building lawsuit, right? Maybe the board also hasn't maintained the property that well and they haven't budgeted that well. So what I like to look at, if it's an oddly low HOA and you can tell the building, has seen some better days, that might be a sign that the HOA is underfunded. So you might be caught with the bag when the seller sells it to you and 2 years later, your HOA jumps up. Now, I'm not trying to dunk on buying in an HOA, right? Because at the end of the day, they're going to be the more cost-effective option than a single family. That way you can get your foot in the door, use it as a starter home. And the reason why I'm making this video is that you're just more mindful of what you're getting yourself into, right? Because I believe that regret comes from imagining the upside of a path that you didn't take without also considering the downsides or the trade-offs. Meaning, hey, an HOA looks like a great option because it's low, budget friendly, and then we're not accounting for the downsides or the trade-offs, right? So if you know what you're signing up for and you opt in and subscribe to the HOA, also subscribe to my YouTube channel, by the way, but if you subscribe to the HOA, hey, I know it's gonna get more expensive, then at least you know what to expect. All right, so those are two talking about the HOA, but now let's step outside because where the house sits can actually hurt you just as much as the house itself.
All right, so the third house that I would definitely avoid is a house that's on a main road or a double yellow. And the thing is, like, you would think that you would get used to the noise, like, it's not that bad. I don't know if you guys can hear that, but there's some noise going on right around now. But it also limits the pool, not like a swimming pool, but like the buyer pool or the available buyers that are trying to buy the place, right? Because if you think about it, most people who are buying houses, most of them are gonna be families. Like for you, I don't know about you, but I wouldn't want to have my, baby boy running around in that busy street, or have my dog running around in that busy street too, even though this house looks amazing that's actually for sale. And it's actually been for sale for well over a year. And I think it's because even though the view is amazing of the ocean, it's because of this double yellow and busy road. And the other thing is, not only does it affect buyers, appraisers also know it's a value adjustment, meaning, hey, if there's two houses, one that's on a main road and another that's not on the main road, and same exact square footage, same exact, bed and bath, the appraiser will actually adjust the value down for the house that's on a busy road. And here's the other thing. Usually if you have to sell for a reason. So you might buy at a discount, but then you sell at a discount. And the reason why I know this is because it's personally happened to me, where you think you're doing so well, you're buying great properties and you're winning. And of course, you get too hot and then you make a bad mistake. So I ended up buying a property that I lost a lot of money on. And guess what? It was on a main road and double yellow. So I'll post somewhere on here our settlement statement where we had to send money as the seller to get out of the deal. So never again will I make that mistake of buying a property on a main road or double yellow. So that's why I'm making this video, so that way you also don't have to make those mistakes and you can learn from those lessons without the scars. So that way you don't get caught with the bag.
All right, so talking about not getting caught with the bag, the best way to avoid that and avoid costly mistakes is to be the most prepared buyer out there. That's why you're watching these videos. This is exactly why I built a free homebuyer readiness quiz, which tells you exactly if there's any traps that you might be running into on the loan or on the mortgage side. That way you know what to fix before you fall in love with the house. It takes less than 30 seconds. There's no credit pull or anything like that. If something needs to get fixed, I'll send you a custom video and I'll send those videos to help fix that specific thing. It's completely free. It's my gift to you. Check it out in the link down below. Okay, let's move on to number 4, what types of house to avoid. All right, so look at this beautiful looking place. It's in LA County, which is historically known to be very expensive, and it's $500,000 for a 2-bed, 2-bath, newly renovated, right? I mean, look at this concrete floors and looks nice. It's so LA, right? Okay, so let's see maybe what the sellers bought it for. I want to make sure I'm getting a great deal. Okay, so let's look at the current owners. They bought it for $600,000 and then they're selling it for, wait a minute, $500,000? So they're making money, or no, wait, they're losing $100,000 if they sold at this price? What's going on here? Oh, it's because it's a TIC property, or a tenants in common, ownership property. So you can tell that because there's no parcel number, and there's in the subdivision, it's saying, Dillon Council TIC community. So in a TIC, you co-own the entire building with other people as tenants in common. Think about like roommates owning the house together. There's also a similar type called co-ops. So in a co-op, you're actually buying shares in a corporation that owns the building, and those shares, give you the right to live in your unit, all that stuff. So here's the trap. With a TIC, you're often sharing one mortgage on the whole building. Yes, you can split it up nowadays and stuff like that, or you're getting the fractional loan that I'm talking about, where you can split it up, right? So you can split up the cost as well. And like I said, the trap is you're splitting the cost too. So you're splitting the insurance, you're splitting the maintenance and all that stuff. So if someone doesn't pay their portion, it could cause some, let's call it some roommate tension, right? And knowing that, it is harder to finance, harder to sell, and a smaller buyer pool. With a co-op, the board has to approve the buyer. When you sell, then they can always turn down people for almost any reason. Financing is always harder. The rules on renting or renovating are strict, and your resale is, again, at the mercy of the board that you don't control. Now, I'm not saying never, ever, under any circumstances, do something like this, but because it might make sense in a really expensive city, it could be a cheaper way in the door, and sometimes that might be the right move. What I'm saying is go in with your eyes open, knowing what you're getting yourself into, like I mentioned, talking about regret, right? You can't just look at the upside of like, oh, I'm gonna buy this super cheap, and we're gonna be just rainbows and butterflies with rose-colored glasses and, marching down the yellow brick road, right? We have to be mindful of the downsides and the trade-offs as well. You've got more rules. The buyer pool is smaller, much smaller, very small. And when someone else, gets to say when you can sell and do what you can do, not that fun. All right, so this one brings me to the last one. And this one is the one where the financing, again, can be a problem because it limits the buyer pool. But again, it also looks like a great deal on paper. And the last house to avoid is a single wide manufactured home. So there's single wides, double wides, triple wides, and so on. So here's a diagram I'll show on the screen here, showing the difference between single wide versus double wide. I remember when I first got in the industry, I had no idea what single wide and double wide meant. Really, just easiest explanation is you have a container of some dimension, if you want to call it that. If you have a double wide, you just have two of them together. If you have a triple wide, you have three of them together. It looks wider. The wider it is, the more it looks like a normal house, right? Because if it's a single wide, it's kind of weird that it's really narrow and stuff like that. So here's the issue. A lot of lenders won't do a normal conventional mortgage loan on a single wide. There's what's called overlays, meaning sure, they might be able to get a single wide conventional loan technically on paper, but there's not many investors that want to have that type of loan on their portfolio. They're just going to say, nah, we don't want to do them, Remember I mentioned, special does not mean good in lending. So the typical traditional bank will definitely not allow most of these types of loans. It's because it's treated like personal property. You need a different type of loan, right? Which usually comes with higher interest rates, shorter terms. And usually, like I said, the rates are worse and just worse overall, or you have to buy it all cash. And here's the other thing. Generally speaking, double wides have stronger appreciation. Not that manufactured homes have super high appreciation anyways, but if you're already going to be on the lower end of the appreciation rate, meaning you buy a house and it goes up in value, single family is usually the highest, HOA is usually second, or condos and townhomes, and then manufactured home will be, below that. So you're gonna be lower on the rate, spectrum thing. You might as well not get it as bad, if that makes sense. So if you're gonna buy a manufactured type home, I would first make sure it's permanently affixed to the land. Therefore, it's actually real property deemed by the lender. Other thing is to make sure it's a double wide. So you got two of those things together, or even a triple wide. From there, I would stay away from single wide if you can, because it limits the buyer pool, meaning less people can bid on it if you ever need to sell. And guess what? If you need to sell, it's usually because of an emergency. So that's what I would avoid. So that's the 5. And notice the thread running through every single one. Hard to finance going in, hard to sell coming out. All right, so I hope you enjoyed this video. Make sure to like, subscribe, and comment what you want to watch next. I try to make the best videos in the mortgage education space. So if you liked it, let me know. And also YouTube is recommending this video right over here. Give it a click. I'll catch you in the next one. Peace.